In this video, we're going to talk briefly about some returns and in particular historical returns. What have the marketplaces looked like over the past, let's say 90 years or so? How do we look at that data? What information can we get from that can help us with making financial decisions today? So the first thing we want to do is talk about how do we calculate returns? The realized return, right? This is the return that actually occurs over a given period of time, is calculated quite simply. It's just the difference in pricing divided by the beginning price. And as you can see here, I have a simplified algebraic equation written here. These two equations are algebraically equivalent. So you take the ending price, P1, add that to any cash flows during the period, and divide that by P sub 0, which is the beginning price. Now, if you also have an exponent here, 1 divided by the nth, 1/nth, right? This will help us to annualize this data. So if this happened for 1 year, the exponent would be 1 divided by 1, obviously 1. So then this would just be what we'd refer to as the average return or the holding period return, excuse me. So another way to do this would be to expand this formula just a wee little bit. So here's an example. So here we have a company. A year ago, it cost $45 a share. You receive $27 in dividends per share. And currently it's selling for $48. So the question is, how well did you do on this particular investment? So again, if we bought 100 shares, again, converting those into the 100 shares, you can see that the beginning value was $4,500, ending value $4,800. $27 was what was received in dividends, $27 total, 27 cents per share. And then, of course, this had 1 year period. So it is a 7.27% rate of return on the investment. Now, this is what's referred to as the holding period return worksheet that's available again with course notes. Now the question though is, what happens if it's not 1 year? What happens if it's what if it took 3 years for this whole thing to happen? So certainly the actual return doesn't change, right? See, it's still 7.27%, but really this took 3 years. So even though it's not correct to do, if you were to divide 7.27 by 3, essentially you would get 1/3 of that every year. Now that's not the correct way to do it because of the time value of money, but certainly you can see that if it takes longer to get the return, then in the end you're going to have a lower rate of return per year or annualized. And that's the point of holding period return. It's an annualized number. So if we look at, continuing on, thinking about some statistics, we're going to be talking about the average returns and something called standard deviation. And in later videos, we'll expand this understanding and concept a little bit more. But I think everybody probably understands a little bit about average. And if you're looking at over time, the arithmetic average, you add up all the returns and then you divide that by t, how many returns you have. That gives us the mean. And of course, the standard deviation is a statistical measure of the frequency or the dispersion of those rates of returns. And of course, these are the arithmetic returns for calculating or looking at actual historical data. Now, if you hold the stock beyond the date of the first dividend, then of course, obviously, if there's dividends, then now you have to incorporate those dividends into the returns. Because as we probably understand, the world works on something called compound interest. So if you reinvest earnings, those earnings themselves will purchase additional shares, and those earnings will be reinvested, and there will be growth upon growth. And now it turns into be an exponential kind of a growth. So now you see how the return is calculated is it is a product of 1 plus those returns. So and just to take a step forward and look at some numbers, I think will make this a little bit easier to understand. So here we have 3 investments. You can invest in the S&P 500 index. There are dividends that are paid to that index. So now we have an annualized return for the years 2005 through 2017. So we have annualized returns for the S&P 500, which includes dividends. We also have the realized returns for Microsoft and also for a 1-month T-bill. So you can see how the returns change over time. Not much change for the T-bills because the numbers are so small, but there are some rather big swings when you look at the S&P 500 and Microsoft. So how can we look at these numbers, look at these statistics? Well, there is a worksheet that's available, and this worksheet is called the Historical Data Return Worksheet. And in this worksheet, you input the returns that you have for a particular investment. Here's the Microsoft returns, here's the T-bill returns, and here's the returns for the S&P 500. Now, if you look down the list, obviously, these are returns we took directly from that table. So the average rate of return of Microsoft was 15.15%, 1.18 for the T-bill, and 10% for the S&P 500. Statistically, you can also see that they line up, that the stock has higher risk, standard deviation is higher than the S&P 500, and it's also much higher than the T-bills. The coefficient of variation also provides us with some indication as to the risk level. So again, what we find here is this is arithmetic average over this historical data. So what does this data look like graphically? And I've received this from a couple other places. This goes to 2015, and we'll look at a little bit later some information that just adds 2 more years. But when you add 2 more years, the numbers obviously change. So what we have here is we have several different types of financial securities. You can look at inflation, that's the CPI, that's this number right here. We can look at T-bills, corporate bonds, a world portfolio, the S&P 500, and small stocks. And we invested $100 in 1925. And as you can see, it gives us what these values would have grown to over those next, I guess it looks about 90 odd years. So how does this work? What does this tell us? Well, certainly we get some very good information. Number one is certainly you need to beat the inflation rate of $1,378. But as you go up, pay attention to a couple of things. Number one is the end line obviously reaches a higher value, but look at the shape of the graph. You can see that the graph at the very top, small stocks, is very jagged. There's a lot of variability in small stock returns. If you go down to the S&P 500, you see not so much. So what happens when returns, or when an investment earns a return, pays a dividend, we reinvest that dividend and it grows? What we find is we end up with these different amounts. So $100 invested in the small stocks would have reached $5.8 million in value by the end of 2015. The S&P 500 is $664,000. I mean, $5 million more by investing in small stocks than investing in the S&P 500. Now, what's the difference? Why? Well, the difference is all about the variability and how things grow and compound interest. Now, if you look at the actual graphs here, the small stocks grew at roughly 12.6%. The S&P 500 is 10.4%. Now, inflation, this bottom line down here, was 2.89%. So what we can say is roughly the stock market grows around 10%. Real small stocks, you could probably get around 12.5%. But the inflation rate over this 90-odd year time frame has roughly been around 3%. And if we look at a table, we can look at this table that reflects this. This adds a couple of more years of data. But small stocks here averaged 18%, and they had a 39% standard deviation. Standard deviation measures volatility. It measures risk. S&P 500, again, 12%. 19% is the S&P 500 as far as standard deviation. So it has lower returns, and thus also it has less risk. T-bills at the bottom, around 3.1% is the standard deviation, and Treasury bills earn on average over this time frame about 3.4%. Again, we said that inflation itself was about 2.89, roughly 3%. So T-bills barely beat inflation. If we look at another picture graphically, this just illustrates how the different financial markets line up with respect to risk and return. The higher the risk, the higher the returns. And we can see that it spreads out here. Small stocks, as we mentioned, have the highest risk. They're also going to provide us with the highest rates of return. So we're going to leave it there for this video. We'll have another video that talks a little bit more about this relationship between risk and return.